Imagine an entity with a significant stake in your bank, your grocery store, your streaming service, and the company that makes your car. Not a government, not a private individual, but an asset management firm. We're talking about the world of BlackRock, a name that has become synonymous with immense financial power. They operate, in many ways, as an invisible hand, shaping the contours of global commerce through sheer scale. Our journey today seeks to understand the true scope of this influence. How do these firms amass such power, and what does it mean for the future of corporate decisions in global economies? Founded in 1988 by Larry Fink and 7 partners, BlackRock began as a risk management and fixed income institutional asset manager. Its rapid ascent was fueled by a unique blend of financial expertise and technological innovation, notably their proprietary risk analytics platform, Aladdin. This platform became a cornerstone, not just for BlackRock's internal operations, but also for countless other financial institutions, providing a comprehensive view of market exposures. From its humble beginnings, the firm quickly demonstrated a capacity for growth that would eventually redefine the landscape of global finance, laying the groundwork for its current dominant position. A significant driver of BlackRock's growth, and that of its peers, has been the rise of passive investing. Instead of active fund managers trying to beat the market, passive funds simply track a market index, like the S&P 500. BlackRock's iShares ETFs, for instance, offer investors a low-cost, diversified way to gain exposure to broad markets. This shift has channeled immense capital into index funds, making the managers of these funds, BlackRock chief among them, major shareholders in hundreds, if not thousands, of companies. This fundamental change in investment strategy quietly amplified their influence. To grasp the scale of BlackRock's operations, consider the numbers. As of recent reports, BlackRock manages assets well into the multiple trillions of dollars. This isn't just a large sum, it's a staggering concentration of financial power. For perspective, this figure often exceeds the GDP of many nations. This enormous pool of capital is invested across virtually every sector of the global economy, from technology giants to pharmaceutical companies, from energy producers to consumer brands. The sheer volume of these assets bestows an unparalleled level of influence on their management decisions. Through their diverse funds and mandates, BlackRock often emerges as one of the largest shareholders in countless publicly traded companies. This isn't just a few companies, it's an extensive, interconnected web. They might own 5% of Apple, 7% of Microsoft, 6% of Coca-Cola, and significant portions of their competitors. This common ownership structure means that BlackRock, representing its clients, has a vested interest across entire industries. The implications of holding such pervasive stakes across competing entities raise fundamental questions about market dynamics and corporate strategy. This intertwined ownership creates a unique form of influence. Ownership comes with voting rights. As major shareholders, asset managers like BlackRock wield considerable power through proxy voting. Each share they hold represents a vote on critical corporate decisions, electing board members, approving mergers, executive compensation, and environmental policies. Their stewardship team analyzes proposals and casts votes on behalf of their clients. While clients technically own the shares, the asset manager typically controls the voting. This centralized voting power can sway outcomes, effectively influencing corporate direction, often without direct public scrutiny of the voting process itself. The influence doesn't stop at proxy votes. BlackRock's executives often engage directly with the boards and management of companies in which they are significant shareholders. These behind-closed-doors discussions, while part of standard institutional investor relations, are crucial. Analysts suggest these engagements can range from offering advice on strategy to pressing for specific changes in corporate governance, executive compensation, or sustainability initiatives. While framed as stewardship, these dialogues hold significant sway given the voting power that BlackRock represents. The exact nature and frequency of these discussions are not always publicly disclosed. At the core of asset management is the fiduciary duty. Legally, these firms must act in the best financial interest of their clients. However, when an asset manager holds significant stakes in numerous competing companies, a paradox emerges. How does BlackRock's stewardship team, for instance, reconcile its duty to maximize returns for all its clients when those clients are invested in rival companies within the same sector? Critics suggest this common ownership creates a potential for reduced competition or subtle influence over industry-wide practices, even if unintentional. The mechanisms for navigating this complex web of interests are often proprietary. BlackRock has increasingly used its influence to push for environmental, social, and governance (ESG) considerations in corporate strategy. Larry Fink's annual letters to CEOs have become significant statements, often calling for companies to address climate change, diversity, and social equity. This push can dramatically reshape corporate priorities, influencing everything from investment in renewable energy to supply chain ethics. While many view ESG as a positive force for global good, others question whether an unelected financial entity should wield such power over corporate societal direction, raising debates about shareholder activism versus public policy. Central to BlackRock's operations is Aladdin, an unparalleled risk management and analytics system. It processes vast amounts of data, offering insights into market movements, portfolio risks, and potential returns. Beyond BlackRock's internal use, Aladdin is licensed to hundreds of other financial institutions, corporations, and even central banks. This means a significant portion of the global financial system relies on BlackRock's proprietary technology for crucial decision-making. Observers highlight that this deep integration gives BlackRock a unique vantage point and potentially an information advantage over market participants, further cementing its systemic importance. The sheer scale and interconnectedness of BlackRock's activities position it as a systemically important financial institution. This status, often applied to large banks, implies that its failure could destabilize the entire global financial system. Such a designation comes with increased regulatory scrutiny, but also underscores the firm's profound influence beyond mere asset management. The decisions made within BlackRock's walls, whether related to investment strategy, risk assessment via Aladdin, or corporate stewardship, ripple throughout economies, affecting everything from pension funds to individual investments and national growth trajectories. BlackRock's influence isn't confined to a single country or market. Its operations span continents, with offices in major financial hubs worldwide. This global footprint allows it to deploy capital and exert influence across diverse economies, from developed nations to emerging markets. Their investment decisions can shape local industries, infrastructure projects, and even national economic policies, particularly in countries seeking foreign investment. This global reach means that the BlackRock reality is a universal phenomenon, touching nearly every corner of the interconnected world economy, making their decisions inherently global in consequence. The theory of common ownership, where a few large institutional investors hold significant stakes across many competing firms, has sparked considerable debate among economists. Some studies suggest that common ownership might lead to reduced competition, as these shared owners could implicitly discourage aggressive rivalry between their portfolio companies. Others argue that this effect is negligible or that engagement from large shareholders actually improves corporate governance and long-term value. The precise impact of this pervasive ownership structure on market dynamics remains a complex and actively researched area. Given the vast scale and potential systemic importance of firms like BlackRock, regulatory bodies globally are increasingly scrutinizing their operations. Discussions revolve around whether existing financial regulations, primarily designed for banks, are adequate for asset managers. Regulators face the challenge of balancing financial stability with market efficiency and innovation. Questions of transparency, conflict of interest, and the appropriate level of oversight for their proxy voting power are continuously being debated. The evolving nature of their influence often outpaces the development of new regulatory frameworks. As asset managers like BlackRock continue to grow, the dynamics of corporate power are fundamentally shifting. The traditional model of diverse, independent shareholders influencing company boards is evolving towards a landscape dominated by a few titanic institutional investors. This concentration of power, while potentially offering benefits in terms of stability and long-term strategic planning, also raises profound questions about accountability. Who truly holds the reins of the world's corporations, and how do we ensure transparency and ethical governance when so much influence operates through complex, behind-the-scenes mechanisms? The reality of asset management firms' immense influence necessitates a greater demand for transparency. Understanding how these entities vote, engage with companies, and manage potential conflicts of interest is crucial for informed public discourse and effective oversight. While their fiduciary duty focuses on client returns, their systemic role suggests a broader responsibility. Advocates argue that public access to more detailed voting records, engagement policies, and internal decision-making processes would empower shareholders, regulators, and the public to better understand and, if necessary, challenge the direction of global capital. For the average individual, this BlackRock reality might seem distant, an abstract concept of high finance. Yet, its implications touch everyone. If you have a pension, a 401k, or any mutual fund, your money is likely flowing through these large asset managers. Their decisions, their influence on corporate strategy, and their advocacy for specific policies ultimately affect the companies you interact with daily, the jobs they create, and the products and services they offer. Understanding their role is not just about financial literacy, it's about comprehending the forces shaping our economic future. In conclusion, asset management firms like BlackRock are not merely investors, they are, in many ways, the architects of global capital. Their vast scale, integrated technology platforms, and pervasive ownership stakes grant them an unprecedented level of influence over corporate decisions and market dynamics. This power, while largely operating behind the scenes, is a defining feature of our modern economic landscape. As we navigate an increasingly interconnected world, understanding these forces is paramount. It's a reality that challenges us to consider where true power resides and how it should be governed in the 21st century.